Why pay more for your precious metals from the big guys with offices on Wall Street and who bank with JP Morgan? From the basics like eagles, maples, rounds, and bars, to collector coins like the Silver Shield and Heroes SD War Collection, to our exclusive line of insurance-approved, TL-rated precious metal safes, SD Bullion has what you're looking for at the lowest prices, period. Guaranteed. Find out why over 15,000 new customers have recently made the switch to buying their gold and silver from the dock. Give our team an opportunity to earn your business today at SD Bullion. Why pay more?
This is the Doc with SD Weekly Metals and Markets Wrap. Joining us today is special guest host, filling in for Eric, who's a bit under the weather, Dave Kranzler, a good friend from Investment Research Dynamics. It's great to have you back, Dave.
It's great to be here again, Doc. Thanks for having me. I'm going to miss Eric this week.
Yeah, he's been fighting a battle here, so hopefully he'll be feeling better soon. But getting to the markets here, it's been an interesting week and I guess an interesting Friday here, Dave. Really all the commodities jumping early in the morning on the news of the overseas rate cuts, and then right in the COMEX open, we got to smash metals back down. Got to get silver back under 16. We got to get gold back. Make sure it's closes the week under the 200-day. Gold was smashed really from about 1180 below 1160. It's closing the day here around 1165, and they've been able to keep silver under 16 throughout the duration of the day. So let's start with the market action. What's your take here?
Well, the thing everyone has to realize here, first of all, everyone knows about just the utterly absurd imbalance between paper gold and the underlying physical gold. And if the people who were long paper gold ever decided to stand for delivery of even just a small percentage of it, it would cause the mother of all short squeezes. But the thing of it is, unfortunately, most entities who are taking the long side, they don't really care to own gold. They're just using their paper gold as a way to index it. And so, I don't know. I do think physical gold and silver are running scarce, as we've gone over that ground several times. And I don't know how much longer they're going to be able to keep satisfying the demand in India and China. We did have a little bit of a lull in the market in India and China, and you can, India was kind of on a little bit of a hiatus before they've got another big holiday season coming up. I think it's actually their largest gold buying holiday. I forget what it's called. And China was out for a bit. And I also think not so much China, but India is also sensitive to higher prices. If they get used to buying gold at a very low price, and they got used to buying gold at around the 1100 mark, and all of a sudden gold, shoots up 10% or 5 to 10%, it tends to put the brakes temporarily on Indian demand. What's interesting, though, and which is being highly misunderstood by the market, is that everyone seems to have learned that you can gauge Indian demand by looking at the ex-duty import premiums being paid, and whenever the ex-duty import premiums are positive, that means that there's a lot of demand for gold over there. Well, a lot of the importing has shifted to doré bars over there, and the reason for that is the excise tax that's imposed on entities that import doré bars. Doré bars would be the raw bars that are produced by mining operations, and then those are sent to refineries for further refining. And they're about 85% pure, as opposed to your standard LBMA or COMEX bar, which is basically 99.9% pure. But what's been happening there is that the importing has shifted to doré bars, and the premiums on those have been running around $20 an ounce. And that, it may sound like a lot, or it may sound similar to the premium that you often see in just the published gold bar premium importing numbers, but it's still a lower price, and it's a lower excise tax. And so a lot of bars are being doré bars are being imported over there by refiners, and that's not picked up by the World Gold Council and some of these other entities that publish or report on Indian demand. And so there is that demand that's still going on. And China, it looks like, they were on a little bit of a hiatus also. It looks like there was, I think I read there was something like 53 tons withdrawn this week from the SGE, and so it had slowed down a bit, and it looks like it's starting to pick up again. So I do think that the above ground physical supply is getting depleted. But just to circle back to what my original, what I was going to originally comment on, and that is that everyone knows that the stock market's totally artificial. It doesn't represent anything meaningful in relationship to the underlying fundamentals, etc. Our interest rates are artificially low. In order for the central banks to try and paint the picture that everything is fine through their market manipulations, it's like, well, how can the economy be bad? Look at the stock market. In order for them to have credibility, they have to keep a lid on the price of gold and silver. Because if they stop manipulating the price of gold and silver and let gold engage in true price discovery, it would send up a red flag immediately that something's wrong in the system, and no one would believe, any part of the message that's supposedly being conveyed by the stock market. And so when you see, like today, I wake up and gold's up $12 overnight. I look away for 30 minutes and boom, it's been hit for $15. And they can get away with that because at that point in time, other than a little bit of trading in London, the physical markets, the physical bullion markets of the world are basically closed for the weekend. And so Friday's a popular time for these guys to step on the price of gold, which they obviously did today. I mean, it went down in a cliff dive fashion. There wasn't any economic news that would have triggered it. If anything, overnight announcements from China and the ECB were very bullish for gold. I mean, gold should have been above 1,200 and silver should have been above 1,600 on that news today, and yet it isn't. And so, I mean, it's just the blatant manipulation that these guys, they have no choice but to try and manipulate it, because otherwise all the other frauds they're perpetrating get undermined. Does that make sense?
Certainly does, and I mean, we've seen it for the last 8 to 10 years.
Even really longer than that. It's gotten more and more blatant. I think what happened was they lost control of it in 2011, and that's when gold went straight up to 1,900, and silver almost hit 50. And I think they were probably given very specific and strict and firm marching orders from the BIS to not let that happen again.
Yeah, certainly it's been, 4 to 5 years now that we haven't had really any sustained upside action.
Nothing, exactly.
Every time either metal makes a breakout above the 200-day, you can see it coming. They're just smashed right back below the 200-day to basically just stamp out any excitement from the funds and the Momo crowd.
That's right. And to be honest with you, I don't really want the Momo crowd in there. I mean, maybe to get it jump started, and that would jump start it if it stayed above the 200-day moving average, because a lot of the black box hedge fund algos would shift from selling rallies or dumping paper whenever the price of gold starts to head lower to buying all sell-offs and pushing gold higher as it moves higher. And so those algos would probably flip, and that's one of the things that the Fed wants to prevent from happening. But to be honest with you, I just don't think hedge fund buying is solid fundamental buying. I mean, the solid fundamental buying is coming from the physical market, and obviously I think the only reason that gold is at the level where it is, as opposed to the $800 that Goldman Sachs and a few others were predicting. I guess that was a popular number at the Denver Gold Show. The only reason that that's not happening is the pressure from the physical market, and I think they had to let the market move up a little bit in order to sort of put some put some brakes on at least the retail physical demand, which you and I discussed a little earlier, has kind of softened up recently.
Yeah, really over the past 2 weeks, the retail demand has calmed down a little bit, and definitely from what we saw in, say, the July, August, early September period. I think a lot of it has to do with grease fears have subsided a bit. I mean, everything throughout not only the alternative media, but even the mainstream media was talking about the blood moons towards the end of September, and we have that passed, and we also have gold and silver up about 15% from lows. I mean, gold was down, like we talked earlier, about the 1070 level, silver right around that 14 level. Neither metals are right now moving day after day after day to the upside that you feel like you're missing out. So I think a lot of investors, there's really don't feel quite the urgency to acquire metals as they did maybe a month or two ago. And the market has quieted down quite a bit from a month or two back. Now that said, the shortage was so severe during that time that a lot of the authorized mint wholesalers still are maybe 4 to 6 weeks from getting caught up on orders that they took and placed back in the August to early September timeframe. So it's definitely a good thing for investors as premiums have been starting to come down quite a bit. 90% silver actually can be found now. It was about 4 or 5 months you couldn't find any anywhere. So that's a good thing. And I mean, really, it's a good thing for silver investors and in general when premiums come down. And I mean, nobody wants to wait 6 to 8 weeks for product to be delivered.
Yeah, I'm also wondering to what extent a lot of the average retail guy who might want to spend money on gold and silver, I wonder to what extent they're starting to feel a little bit of a pinch on their discretionary or disposable cash flow.
They all just got their Obamacare notices for what their premiums are going to look like next year.
That's true too. There is a big element to that.
I mean, when your healthcare premiums jump another 50%, I mean, a lot of people that's a big cut into disposable income.
Yes, that's a big nut for most people.
Why don't we shift gears a little bit here, Dave, and talk a little bit about the piece you put out on the massive surge in reverse repos that began at the Fed really here over the last month or two.
Sure. What's happened is that really since probably the beginning of 2014, I don't have the chart right in front of me, but we've seen a real uptick in the amount of reverse repos that are being done by the Fed. And the reverse repo is obviously it's the opposite of a repo, in which, you know, a repo is where banks need very short-term liquidity or cash funding, and so they basically borrow cash from the Fed and they put up treasury bonds as collateral, and that's a repo. And they generally go from, you know, overnight to a couple of weeks. It's the repo market is considered sort of the engine oil of the world's financial system. And the reverse repo is kind of the opposite. And it's, I guess they're both operations are a way for the Fed kind of to fine tune very short term interest rates, or the Fed funds rate, by regulating the amount of immediate liquidity and therefore the cost of that liquidity in the banking system. This is all interbank activity, but I think what's going on here, what you've seen since 2014, and it really, someone brought it to my attention in December of 2014, is that all of a sudden you get these big, huge spikes up in reverse repos, and we're talking massive. And a lot of people have said, oh, well, you know, this is just quarter end balance sheet management because banks don't want to show cash on their balance sheet at the end of the quarter, because then investors, you know, big stockholders will say, hey, why are you sitting on cash? You're not earning any money on that. So what they do is they do a reverse repo with the Fed, where the Fed puts treasuries onto their balance sheet and the cash moves to the Fed. And they do that through the end of the quarter, so that when the auditors put their books together, they show treasury assets instead of cash on their balance sheet. Well, yeah, there is for sure end of the quarter balance sheet management, but not to the degree that it's going on right now. I mean, when you see these massive spike ups, I mean, we're talking, a couple $100 billion. Historically, quarter end reverse repo balance sheet management isn't anywhere near close to that side. And moreover, a large portion of those reverse repos are going to foreign banks. And what I think is going on is everyone knows about, there's a large shortage of collateral in the system. Collateral meaning when financial entities have to put up collateral to post collateral against losing derivatives positions, they use treasuries, and that's what the market demands, and that's what's used. And there's been because of all of the so-called QE buying by the Fed, it's removed a lot of the available collateral out of the marketplace. I mean, some of these issues, like I think the 10-year, I think the Fed owns something like 50% of all the 10 years that are issued out there. So there's been a perpetual squeeze in available collateral, and Zero Hedge has documented this over the years. So it's not like I'm just making this up. And what I find interesting is that the big spike in repos seems to have occurred right around the time when it also was apparent that there was a lot of stress going on in the derivatives market. So for instance, at the end of December, if everyone remembers, the price of oil started crashing in the summer of 2014. Okay, well, guess what? A lot of entities were hedged out on the price of oil on the potential downside, but those hedges roll off. And so all of a sudden, if you're a derivatives counterparty entity and you're getting a margin call on your oil related derivatives, you got to post more collateral or you got to close it out and pay what you owe. Well, it's most people, these derivatives always just seem to roll forward, but you got to post collateral. Well, you go out into the marketplace to try and find some treasuries that you can use to post. Oh, no treasuries available. Well, the Fed, the big reverse repos are a mechanism by which the Fed can push collateral from its balance sheet, treasury collateral from its balance sheet, out into the banking system, where it can be made available to use as derivatives collateral. So let's say a hedge fund all of a sudden is in a losing derivatives trade, but it needs collateral to post against that because it doesn't want to have to settle it up, and the bank who's its counterparty doesn't want it to have to settle up. So the bank engages in a reverse repo transaction with the Fed, and then it'll hypothecate that collateral to the hedge fund. And that's how this collateral would indirectly get from the Fed's balance sheet out into the marketplace, where it can be used and posted as collateral. So and then then they can go and address derivative shortfalls from there. And I think that's what's been going on. And again, to sort of debunk this idea that the big spike that we saw in September was a quarter end balance sheet management operation. I mean, first of all, it was the largest spike up in reverse repos that we've ever seen. Over a third of it went to foreign entities, and it just so happened that the spike up, it was like a 2-week spike up, and it just so happened to coincide with when Glencore stock all of a sudden dropped about 50% in the space of a couple weeks, or maybe even a week. Again, I don't have the chart in front of me, but I have a chart on my blog that shows that. And so if you're telling me that, and we know Glencore obviously is exposed to every bad sector out there, and Deutsche Bank is one of Glencore's largest lenders. And so I'm sure there was just all kinds of credit default swaps and energy and copper related derivatives that all of a sudden were way off sides. In other words, they were out of the money and they were going to require collateral to be posted up against, or close them out and pay off your counterparty. So, I mean, what happened starting in the middle of September was something that was way, way bigger than quarter end bank balance sheet management. And so to me, what it tells me, especially when you look at the volatility if you go look at the graph on my blog, you look at the volatility of the reverse repo activity and just how extreme it is versus, say, the previous 10 years. Because I think I show it going back since before the financial crisis. I think I took it back to 2005. to me, it's a reflection of just how volatile and dangerous all of these OTC derivatives are starting to become, and also how unmanageable they're starting to become.
So are we out of the water in regards to Glencore?
Oh no, I don't think so. I mean, the stock took another dive, and it wasn't until the last couple days when the central banks went in there and really propped up the stock markets that Glencore bounced a little bit. But no, Glencore is not even close to being out of the water. In fact, I wrote a piece on Glencore earlier this week, and I mean, there's been a lot of misinformation about exactly what's going on at Glencore, but if you look at their business exposure, it's basically primarily copper and coal, and both of those commodities have just been annihilated. And I can guarantee you the price of copper is going to start going a lot lower, and it has a lot of room to move a lot lower because it's not as low as it was back in 2008. And I can tell you right now, the global economic situation is probably at least as bad as it was in '08. It may be worse. So that's one of the things, is that Glencore's got just basic business problems. And then you pile on top of that, originally had been reported that they had $19 billion in debt. And I went and I dug through their latest financials, and as it turns out, when you include their credit facilities, their gross funded debt outstanding is over $50 billion. And then the number that everyone was publishing away from that was this $29 billion number, and that was what Glencore calls its net debt. So what it does is it's got this inventory of readily marketable inventories, presumably copper and coal and aluminum inventories or whatever. And so they say, well, this is ready marketable, and we have 17 billion of it, so we're going to net that out against our debt because we think that's just as good as cash. Well, you owe that debt. You have these commodities sitting on your balance sheet that you say you can turn into cash readily. So why don't you do that and pay down your debt? Well, the answer to me is obvious. It's not readily marketable, and it's the type of inventory that if they started unloading it on the market price, they'd push the price of copper and coal even lower. So it's just pure financial manipulation. So really what Glencore has is $50 billion in debt, and that's a lot of debt for a company that is barely generating more than a couple billion of cash flow after CapEx. So if you're talking about an entity that's valued right now at 20 to 25, the debt is funded at 20 to 25 times free cash flow, you're talking about essentially an insolvent company. So no, I think Glencore is far from over. I do think that the banks and the central banks are working furiously overtime behind the scenes to try and keep a floor underneath Glencore's commodity exposure, and I think they're working furiously behind the scenes to try and prevent credit issues from surfacing here. And we had a big bounce in the stock after it had in March. Glencore stock was at 320, I guess it's measured in pounds. I have a Yahoo graph on my article on the website. It might be in dollars. So let's just call it $320, and it drops down to a low of $66 by October. Now that's a stunning drop. That's worse. That was quicker than Enron's descent. And out of nowhere, we had a big bounce. It bounced back up to 130, and then earlier this week it was down as low as 110, 109, and it's bounced again. But that, to me, that's just correlated with what the S&P and the European bourses have done this week. Ever since, to me, it was apparent that the central bank stepped in and propped these markets up. But I think with Glencore, if the invisible hand of central banks and too big to fail banks weren't in there trying to keep a floor underneath it, I think that stock would probably be significantly lower than it is right now. And I do think ultimately it's going to be a situation that probably blows up.
How much longer do you think those central bankers are going to be able to forestall that?
Your guess is as good as mine. It's funny because I was discussing this generically with a friend and colleague of mine earlier. How long can they keep kicking this can down the road by printing money? And I mean, the answer is no one knows. I don't even think they know. I think all they're doing right now is every time one of their cabal has their hair on fire, they shower it with water and try to put the fire out. And I don't know at what point in time they're going to try and put that fire out with water, and it's going to turn out that their pail was full of kerosene. I just know that it is going to happen eventually. It's who knows when.
All right, one more macro question here, Dave. As we get into the fourth quarter here, what's the biggest systemic risk into Q4 and then 2016 that nobody's looking at right now?
Well, I don't know if anyone's looking at this or not, but again, ultimately, they can print as much money as they want to inflate the asset markets. And that's what they've done since 2009 when the QE started, and basically the global QE started. Japan's been doing it forever. I think the economy itself, both here and in Europe, and obviously in Asia, I think the economy, especially in the United States, is a lot weaker than people are willing to believe it is. I think if you were probably to do some boots on the ground due diligence in some of the lower middle class and even basic middle class areas of this country and talk to people, I think you'd get a completely different impression of what's going on in the economy than you might get if you turn on Fox Business or Bloomberg or CNBC or listen to the politicians on TV. And I don't think that truth is being reported on, but I do think that I think this economy potentially hits a wall. I mean, a real wall before the end of the year. And I'm talking about if last year December retail sales were slightly negative, which never happens during a holiday season. I mean, retail sales are almost always never negative anyway because there's always just inflation built in. I think we could probably see the worst holiday sales in memory this year, and that'll be a direct reflection of just how terrible the true economic condition is of our system.
Well, as we record this here about 5 o'clock Eastern on Friday after the markets closed, really the biggest story of the day is developing to be the hurricane that is Hurricane Patricia that's bearing down on Mexico. Been recorded now as the largest hurricane in history, over 200-mile-an-hour sustained winds. So we're definitely going to keep Mexico in our prayers. It looks like they're going to be hit pretty bad. And it'll be interesting to see if and how much Mexico's mining industry is affected. And Fresnillo comes to mind as a big presence in Mexico, and I mean Mexico has quite a few silver mines, so it'll be interesting on the supply side to see what, if any, impact that this storm of the century has on mining production in Mexico.
It's funny that you talk about that because when I saw that news about that hurricane, the first thing I thought about was the mining stocks that we have in our fund, because we have a few juniors that are largely based in Mexico. It's interesting. You were thinking about it in terms of the silver supply issue, which Mexico, I think, is the second or third, maybe it's one of the top 3 largest silver producing areas in the world. And if this hurricane causes a disruption in Mexico's ability to produce silver for a while, we could see some fireworks in silver. Maybe that's a black swan no one's looking for.
The listeners will probably have a little bit more idea by the time they're listening to the show over the weekend than we do right now, just how much of an impact the storm is going to make. So we certainly hope that it doesn't and it weakens or turns at the last moment. Doesn't look good right now.
It's definitely hitting the coast of Mexico. In fact, it's supposed to hit in the next 3 or 4 hours.
Yeah. All right, we'll keep the people of Mexico in our prayers this weekend. Before we wrap up the show, Dave, if you can let listeners know where they can find all of your regular, excellent work, as well as some of your subscription options.
Oh, thanks. I don't know if my work's excellent, but I appreciate it. My blog is investmentresearchdynamics.com, and I try to post at least 2 or 3 commentaries a day if I can. It sort of depends on my general level of agitation, because I look at it as a lot less expensive than going to see a psychotherapist once a week. And then from my blog, I offer some very specialized, and I like to think as in-depth research as available that's out there on home builder stocks and the housing market, on junior miners. And I also have a special report up there on Amazon, which, again, I haven't drilled down in depth on the numbers that they released yesterday, but the headline earnings and revenue reports were highly misleading. So I'll have a lot more to say about that. Hopefully I'll find time in the next week or two to get something up on that.
All right, it's always great to have you back, Dave.
Hey, it's always great to be here. Anytime, Doc. I love doing the show with you.
All right. For Dave Kranzler, this is the Doc. Thanks for tuning into this week's SD Weekly Metals and Markets.